Eurobonds, pricing and liquidity of the market for Eurobonds, we've been paying for some while. And it's really an empirical paper. We're informed by some theory about how we think liquidity and pricing interact, but it's also not just for economists, it's really also designed for practitioners in this area, debt managers, sovereign debt managers, and investors. Eurobonds are an important asset class. This of importance both for finance and macroeconomically. It's one of the major ways, they are, by the way, just find them, these international bonds issued mainly by emerging market and developing country governments. There are also some non-government issuers. They're really the successors to those sorts of bonds that Brian was talking about yesterday, issued in the 19th century, and they've evolved into what they're called Eurobonds for some reason. They are the way capital flows to and from emerging market countries. Some of them can get restructured. Currently, there's about $1.5 trillion of Eurobonds, sovereign Eurobonds outstanding from these issuers, about 80 issued countries. I think also some in Europe, but not Africa, Latin America, you name it. And they have been growing quite rapidly. When, in the 80s, many of the capital flows to emerging market countries were from banks. Now the main market channel are these Eurobonds. So it's worth studying them because they have practical importance to the world. I think it's also worth studying because they kind of are good subjects for empirical analysis. They are homogeneous in some regards and relatively heterogeneous in others. So there's a certain amount of variation. They're all the fixed income bonds, those all in dollars. They tend to be medium term, say, 5, 15 years, something like that. But they're heterogeneous in terms of the size of the issuer and the individual issues, the credit quality, and also some of the particular features of the terms and conditions, including, for example, the inclusion of what's called collective action clauses and pari passu clauses. A collective action clause is a provision in the terms of a bond allowing a supermajority of owners to vote and approve a restructuring. So if they think the country's not able to repay them, rather than go to default, the investors can agree to change terms, say to extend the loan. And there's also something called a pari passu clause, which essentially requires that the country not treat different investors differently. Everyone has to be treated, given a comparable alternative. So typically a country which wanting to restructure will say, you can have this package or that package, and they're about the same present discounted value. These provisions are common, I think, in private sector debt. We only really got going in this century in these Eurobonds, and they also modified in light of experience. In other words, they're called enhanced collective action clauses, which allow voting not bond by bond, but by the bonds taken together. That way, it's more difficult to have holdout investors, so-called vulture funds. This was done in reaction way to the Argentine experience. Okay. So I think they're worthwhile to investigate and also suited to be investigated. Oops. Yeah. And the background to the study is also some really central themes in finance: what determines yields on assets, and also what makes a market liquid. We often use this term market liquidity. It's quite a complicated concept. We kind of know it when we see it. But those are two central questions in finance, which we'll be able to say something about. Obviously, this is an area being very extensively studied. There are lots of theoretical and also empirical papers looking at other markets, which I cite here, but I don't want to bore you with a literature review. So let me get on a bit. Just the notion is that a more liquid market for security should be rewarded by a lower yield on that security. So people are willing to accept some lower coupons or whatever in exchange for the convenience yield of liquidity. So that if the market's liquid, they can cheaply and quickly change their positions, buy more, sell some. at low cost, and that's worth it. They're willing to pay more, they just drive down the yield a bit for the more liquid instrument. And then what makes the market liquid is sort of largely a matter of having the right sort of investor base, which is large, diverse, and willing to trade. All three elements being important. Liquid means you can quickly find somebody willing to do a deal with you to buy or sell. So therefore, it's easy to find people that, if there's a big investor base, but it also needs to be diverse. If everybody's on the same side, you're not going to find somebody to trade with. And you also need to be willing to trade. So, for example, there's some instruments you may have a, widely held, but largely held by buy and hold investors who are not, sell it to you no matter what. So you want that sort of big, diverse investor base to generate the liquidity, which then can lower your yield. But as these arrows here in this little diagram already make clear, some of the features that generate liquidity may just mean lots of demand for that asset in any case, and therefore lower yield. Maybe rather difficult to tell apart which effect is most important, whether the investor-based phenomenon drive more market liquidity and therefore low yield, or whether the investor-based properties just drive down yield itself. We've got kind of an identification problem here. To elaborate a little bit, we think this large diverse investor base, it's a narrow bid-ask spread, and related to things like the issue volume. Before people are going to buy an asset, they will do some research, and so it's not worth doing it unless there's sufficient volume being sold. The likes of PIMCO and BlackRock are not going to bother with some asset issued in which is only 10 or 20 million issued. They want hundreds of millions issued to make it worthwhile. The entire country probably have to issue a lot to make it worthwhile, so that every major investor is going to do research on Brazil and South Africa, but many investors are not going to bother doing research about some very small issuer like a Caribbean island. Possibly also a consistent issuing pattern. Regular issue is considered attractive, at least the market participants say so. Duration will matter to the size of the investor base. Duration being a product of both remaining maturity and the coupon. The phenomenon of seasoning. Newly issued bonds are more liquid than ones been around a long time. And then also sovereign risk matters, so that the more risky the asset, the fewer investors will be willing to take it on. You notice by the coupon appears in two places here. This coupon affects duration, but is also a signal of riskiness. I'm going to go fairly quickly. And then there's also other things captured by fixed effects, including the presence of these so-called collective action clauses, the jurisdiction of issue, the things that are issued normally in New York or London, and then whether it's included in a bond index. So, I managed to assemble a rather large data set, end of quarter prices and other features of Eurobonds for, I think that's 9 quarters, and I'm focusing on emerging market US dollar denominated bonds. It still leaves me with and after a bit of trimming, I have more than about 4,400 observations. That's a lot. And that's trimmed off some of the more extreme observations because there were sort of the restructuring cases. I data even on bonds from places like Venezuela, which are just like totally defunct, and a few other restructuring cases as well, which are like really big outliers, but still left with a lot of observations. Typically in my life, I've done a lot of macroeconomic work, and there, if you get 150 observations doing well, here, you're not worried about degrees of freedom, endless degrees of freedom. Most of the Monte Carlo studies don't extend to sample sizes this big. I don't want to spend a lot of time looking at the data, but a few things which are worth pointing out. First of all, many of the variables are distributed in ways that are very asymmetric. On the left, for example, we have the bid-ask spread, and bid-ask spreads are always positive numbers. And some of them are very large, well over 100 basis points. But even excluding the tail, the distinct a skewness distribution. And likewise, the yields too. There are no native yields in my data set, but that's a very large ones. Also, just eyeballing the data, you see some clear relationships. For example, on the right, we have the volume issued, and the vertical axis is the bid-ask spread. And they see that it goes nicely down, and this then tapers off a bit. It's not linear, but it's pretty strongly there, up to a certain point. And then also, in our two main concerns, yields and liquidity is captured by the bid-ask spread, there's something there too. I mean, this includes the outliers, but you see there's a really strong relationship between these two. Even if you exclude lots of these outliers, there's a lot going on there. As an aside, and this came up the other day, the bid-ask spread is not the only measure of liquidity, but it's the one we have. Furthermore, if you look at the literature in this area, the bid-ask spread is generally about as good as anything. There are alternatives, but the others don't buy you that much. If you have quantity data like order books, that shows more information. But all the price-based measures end up being pretty well correlated with each other. That's why I stick with it. Okay. The main regression results with this reduced form. We know that the bid-ask spread and the yield are kind of related to one another, but they're both endogenous. But let's start by just looking at the reduced form, where we take on the left-hand side either the yield or the bid-ask spread, and on the right-hand side we have all these bond characteristics. So we're not actually explicitly modeling the interaction between the two. And all the right-hand side variables are going to be nicely predetermined. In some cases, they're determined when the bond is issued years in advance. So we don't have much problem about that. And then I adopted a Translog specification because I wasn't sure whether all relationships were going to be linear. There might be some curvature, some might be non-monotonic. This allows that possibility. I also was concerned to use the logs of variables. As I mentioned, particularly the left-hand side variables have a quite support only in the positive numbers. And so if you're going to have get normal errors, you better take logs first. And the other thing which became very rapidly apparent is that the credit ratings, the credit riskiness of the issuer mattered a lot. And so I took cross products between the explanatory variables and the credit ratings. One implication, though, is that we kind of have a built-in multicollinearity. That all these variables on the right-hand side, they interact with one another, they're strongly correlated with each other. And the individual parameter estimates will be rather unstable. However, you can use wall tests, F-tests, to test whether groups of variables are important. And that turns out to work pretty well. So here's the specification in more detail. You see the log of some variable there. And then we have, for explanatory variable x, it's log there, the same thing squared, the cross product with the credit rating, and the cross product with the credit rating squared. We do something similar for the dummy variables. Of course, we don't square them. We have, this is the issue year dummies, because we think the market has evolved over time. So things issued in 1990 may behave differently from things issued in 2010. And then we have these fixed effects for the observation period, so the dummies, which period. And these things capture the global conditions of the time the observation is made. And particularly, it captures the safe interest rate. So when I talk about yields, it doesn't mean that raw absolute yield. It's not a risk premium of a safe rate, because that's already captured by this fixed dummy for the period. We don't even need to say what the fixed rate is. What's that? Now, the worst thing about the specification is that you end up with dozens and dozens of parameter estimates, which are rather difficult to interpret. So what I do, and I'm going to show you later, is I then project back from these estimates to what would be the effects on the levels, and then show them in charts for typical values of the variables. That's going to be, I think, much more intuitive, the results. As what we get, turns out we get lots of significant parameters, lots and lots of them. Explanatory power is pretty good, 0.66 at least for panel discussions. Maybe a phenomenon we've had so many observations, but when things are significant, they're very significant. You get significance levels of, not 1%, but 0.1%. It's not unusual. Let's start looking at the interesting things. What is the influence of different bond and country characteristics on bid-ask spreads and yields? So the left-hand picture shows the volume of issue and how that affects the bid-ask spread. Mean, by the way, about 0.55. The one on the right is for the yield. The different colored lines correspond to different levels of the credit rating. The 13, which is about a triple B, I think, that's the most common one in the middle. And so this light blue one is quite high rated. I think that's an A- or something. And this dark reddish color is, I think, a triple C or B- is the weakest one. And what you notice for most of the bonds is very distinct downward slope up to about the level of 1.5 billion issue volume. And then it tapers off quite a bit. And there's a bit less of effect for the better rated bonds. But for the very badly rated bonds also, there's not really an effect there. It's much flatter. If anything, the more there's issue, the more difficult, the wider the bid-ask spread. And that's one side. On the other side, if you look at the yields, there's a very similar pattern where small volumes associated with high yields, and then tapers off once you get to about 1.5. And plausibly, what's happening is that the liquidity effect here, the spread, is translating into the higher price. This is the relationship where low liquidity, the bond ends up having a high yield. And once liquidity becomes good, the yield falls off. And again, the very weak bond behaves differently. That may be just price elasticity of the bond. And also the very strong bonds, these light blue ones here, which are high investment grade, they behave differently as well. In fact, there's very little difference by volume for them. But we also know some kinks here and there. These are threshold dummies which I've included, and it's definitely a threshold about 500 million issue size and a billion issue size. Conscious of time, I'm going to go this fairly quickly, but just see this, for example, is maturity. The maturity yield curve is not independent of credit rating. Here's seasoning. I mentioned earlier that new bonds are more liquid than old bonds. And what happens is that this is aged on, say that for a 15-year bond. So most of the time, age doesn't matter. When you get to the last couple of years, the liquidity collapses and also the yields go back up. It's one of the reasons why debt managers often then buy back the bonds just in the last while before they mature, is that the price falls off. Okay. Again, we have the suggestion that it is possible. What's happening is that this lack of liquidity is what's causing also the yield to go up. Here's credit rating effect. This, I include also the current credit rating, but this is actually the credit rating at the time the bond was issued, many years in advance. You notice that on the right, the effect on yield is as what you expect, and that the better the credit rating, the lower the yield. There's also, it affects also the bid-ask spread. It doesn't really affect, once you get up to about mid-range here, no big deal. The weak ones, the low bid-ask, the low rating, the high credit risk, creates a high bid-ask spread. And this is very persistent. This is like the credit rating at the time the bond was issued 5, 10 years ago, and even aligned for what's happened to the credit rating today. You find effect of the jurisdiction, but similarly, whether you issued in New York rather than London, there's also an effect for the weak bonds, because jurisdiction matters for in the case that there's a restructuring. So for the highly rated bonds, things that goes away. It doesn't really matter. But for the weak ones, what might really come about, you care. And likewise, the inclusion of a so-called enhanced CAC has a very distinct effect, mostly it improves liquidity for the weakest bonds. People appreciate it. People are more willing to buy these bonds, more diverse, large investor base if it includes one of these collective action clauses. And that's also matched what's happening to the price. So this is a sort of technical provision in the terms of the bond translates into an appreciable improvement in both liquidity and reduction in yield. So if you're a sovereign issuing this stuff, it's a good idea to include it, especially if you're relatively weak. And here you're reducing your extreme case, you're reducing your yields from 475 to about 400. That's real money. That's 75 basis points is a lot when you're issuing billions of this stuff. Certainly worth paying your debt manager something so that they think about this, get it right. Just say, back in the paper, I did a lot of work trying to check the robustness of the results. They do seem quite robust, except the very highly rated bonds. They behave differently. My notion is that the really highly rated bonds of countries like Chile are effectively just like advanced economy bonds. And so the individual bond characteristics don't matter as much for either liquidity or the yield. Whereas when you get down to more idiosyncratic, strange cases, I don't know, Ecuador versus, Papua New Guinea, then these idiosyncrasies matter more to liquidity and so on. I also looked at just variables known at the time of issuance. So this is what the debt manager, when he or she is deciding to issue stuff, can set, and where they can project how these bond characteristics are going to affect liquidity and yield for the life of the bond. And it turns out that even dropping what's unpredictable at the time of issue, you still explain quite a bit of the variation across countries, and most of the effects persist quite well. I don't have time to go into it in great detail, but just show like this against the issue size, right? And it's something very similar, if anything more pronounced, that for having issue size below $1 billion costs you a lot in terms of liquidity, and that also corresponds to costlier debt. The yields are a lot higher. You go down in size, and particularly if you're below 500 million. And there's a sort of trade-off there, by the way, because if you're a small country, you don't want to issue debt and have a very lumpy debt structure. So there's some optimal point there to choose in your debt management. So, just in time, I wanted to try and look at the direct effects between liquidity and yields. The trouble is I didn't have any good instruments. My right-hand side variables explained both variables too well, and they kept on failing the over-identification tests and so on. So all I could do was to control for all the available explanatory variables, and I ended up regressing the yield and the bid-ask spread and so on all those variables, taking the residuals from those regressions, and then regressing the residual yield on the residual bid-ask spread and various other and square of that and times the ratings well. And even after all those controls, I found a very significant and positive relationship between the bid-ask spread and the yield, almost independent of rating furthermore. And this shows if you get your bid-ask spread down by about 10 percentage points, it translates into about 80 or 90 basis points reduction in yield. Again, that's real money for these countries. That's $9 million a year on a $1 billion bond, and that for every year of the bond. So we do seem to have some confirmation of this very strong relationship between liquidity and yield. Takeaways: bond design has an economically significant effect on yields and bid-ask spreads. Design aspects like the issue size, the maturity you choose, the inclusion of enhanced CAC. The liquidity risk is indeed priced in Eurobonds, And therefore, for example, if you just look at a bond yield, it's just not an indication of credit risk, but it also includes a component relating to liquidity risk. The effects are long-lasting. They what you set it up when you issue the bond, and that lasts for the life of the bond. However, the effects vary a lot with credit risk. The more the credit risk, the more the effects come out. So our theories are largely corroborated, not perhaps confirmed, but at least corroborated. There's an opportunity for investors, market practitioners to trade off yield against liquidity, but also the debt management is rewarded. If you can manage your debt and reduce the cost of funding. And finally, to say that having done this, I think a very interesting application would be to look at the determinants of yields and market liquidity as captured by bid-ask spreads in local currency bond markets of emerging market countries. And then we could ultimately get to the point of trying to make recommendations to countries like Ghana, whatever, about how to design their bonds to make them more liquid and in fact reduce government's cost of funding. So thank you. That was the quick tour of what's a rather long paper.
Hey, thank you, Daniel. Flavius, you have some discussion comments for us.
So first of all, I will read the comments of Professor Tache on behalf of Professor Tache. So here we go. This paper is a valuable contribution to the financial market literature, helping to better understand Eurobonds as an important asset class and elaborating the connection between yields and market liquidity. As the author stresses out in the conclusion part, his research results are both of academic and practical interest. At the same time, his paper offers extended field for further research, such as looking at the determinants of the bid-ask spreads, yield of corporation Eurobonds. I consider this paper as an impressive achievement, deserving indeed the recognition of a hard work and rich experience in this field. Actually, it's kind of the paper that you'll only say congratulations about. So this is the comment received from Professor Tache. Regarding my comment, it would be, I really enjoyed I'm a PhD student. I'm not at the level of a professor, but still, I really enjoy the visual impact of the charts in general. For me, I really believe that having so many charts together with explanations offer a very good understanding of the paper, much better than simply reading numbers or words. So I do appreciate this paper a lot. I didn't have time to fully read it because I'm in the. I have to present to the two papers, but still I'll do that after. Thank you very much.
Okay, do we have any other comments or observations on the part of the participants?
May I quickly say, first of all, thank you, Flavius, and to your professor for those kind words. I appreciate that. And, what I myself am most worried about is this difficulty of this lack of instruments that I have, and I haven't found a way around this. So if anybody's got any bright ideas, what sort of instruments I could have, please let me know.
Yeah, yes. Thank you. Sure.
I think lack of instruments is a problem generally whenever you get into macrofinance. Everything seems to be correlated with everything else. Everything's endogenous in macro. I do have a couple observations. First is, I was really amazed at how comprehensive this study is. I'm at a loss to think what a debt management officer or investor would want to know beyond what this paper says. I'm also amazed at how strong the results are. You know, R squares of 0.50 or higher, much higher, and a lot of statistical significance. And I'm reminded of a paper that Hans Stoll did, must have been back in the 1980s, where it was a paper similar to this, but he focused on equities and not on euro bonds. And he also got very strong results. And he just pointed out, as an aside in his paper, that these are about as strong as results get in finance. And that strikes me as being interesting, because I go to many seminars where people present papers, you know, showing empirical results with huge panel data sets of data. And the R square is rarely above 0.10 or 0.15. So, you know, what's going on here? Why do we get such strong results in microstructure? And I just think it's a reflection of how well these markets operate. You know, you've got a lot of very people devoting a lot of resources to try and get the pricing right, and just looking at all the details of the individual issues. One other last observation was just how important the investor base and the seasoning is to the pricing, the bid-ask spread, and the yields in these bonds. Darie had mentioned Chile, sort of with respect to an interesting observation that the spreads sometimes go up for the very highest rated bonds. Chile's a really good example of that. I used to work with the emerging market debt trading desk at JP Morgan, and we could not get about half of their clients, and I think at other investment banks, more than half the clients are actually hedge funds. Now, they're not all investors by any stretch of the imagination, but I do recall how difficult it was to sell Chilean bonds, to get them interested in buying Chilean bonds, because at the time, Chile did have and still has a pretty high investment grade rating. It was the only country in Latin America for quite a while that had an investment grade rating on their bonds. And the reaction we'd get from investors was, we would say, oh, Chile really trades just like an OECD bond. It has equivalent credit rating of credit standing of an OECD bond. And the response we get is, yeah, well, if I wanted to buy an OECD bond, I'd go do that. You know, they were interested in leverage plays on the lower rated euro bonds and in search of equity-like returns. There was a colossal lack of interest in bonds, higher rated bonds like Chile's. And then finally, the paper did point out that liquidity sometimes seems to drop off with seasoning if a bond's been around for a long time. And it's sort of a little bit of a perverse effect, in the sense that sometimes the original issue can be very large and there's a lot of demand for it. The trouble is, often these bonds, it's not just euro bonds, but also in particular US corporate bonds, or UK gilts for that matter, get snapped up by long-term investors who never sell them. You know, they hold them in portfolio. They've got products, long-term products, you know, the liabilities against them. And it's actually gotten to the point where some large US corporate bonds don't even trade every day, you know, for names that you would recognize. And I can remember speaking once with the manager of ING's fixed income funds, some of the largest in the world. And two of his funds didn't own any bonds at all. Two fixed income bond funds actually had all of their holdings were credit default swaps, you know. And the reason for that was the CDS was more liquid than the bonds. But anyhow, very interesting paper. Thank you.
Thank you. And just say some of those points are kind of in there. I mean, like, you know, I think this chart, by the way, shows why you're getting a good R square. I mean, this is just the raw data just shows a very strong relationship. And that's what we'll drive off. And again, the thing that, like, I think it's actually something I leave the post next. It's coming next. There's like boring times when there's not much news. There's also little liquidity because people are not having a motive to move. And so, like in Chile, if everything's running well, it's dull. You know, you're a bond bore, And then if we've got some country like Argentina, which every few years of defaults or something, there's something to talk about, something to trade on. But I shall leave it at that. And thank you very much for your kind words. And over to the others.
Okay, do we have any other comments? Okay. I think it's time for Fumiko to present her paper.
Thank you. I'd like to present my paper co-authored with my former student, Yuki Suenaga. In this paper, we aim to examine how stock markets react to the postponement of the Tokyo Olympic Games, which was scheduled to be held last year. As a result of the COVID-19 pandemic, the postponement decision was made on March 24th last year, and in the past, although the Olympic Games have been cancelled 5 times, they had never postponed. So the Tokyo Olympics could be the first opportunity to analyze the impact of not holding the Olympic Games on time. The organizing committees of the Olympic Games are sponsored in the four following areas: funding tournament operating expenses, increasing the Olympic Games brand value, promoting the Olympic movement, and raising funds for athletes training. Sponsoring the Olympics can be useful for promoting products and services and enhancing brand value. Since the Olympic Games aim to achieve world peace through sports, they are likely to enhance the image of sponsor companies' brands. At the Olympic Games, the sponsor company's logo is placed on the stadium to raise awareness. In addition, only sponsor companies can use intellectual property related to the Olympic Games by selling products associated with the Games and broadcasting TV commercials. However, high sponsorship costs and ambush marketing have reduced the cost effectiveness in recent years. In particular, for those who are not familiar with the word ambush marketing, I'd like to add some information. This may diminish the benefits of official sponsors. Ambush marketing is carried out by companies that do not have formal rights as sponsors but take advantage of the Olympics. For example, Wendy's associated itself with the 1988 Winter Olympic Games by featuring ski racing posters, printing Olympic stories on its tray liners, and sponsoring ABC's broadcast of the Games. Similarly, after the 1994 Winter Olympics, only 37% of surveyed TV viewers correctly selected McDonald's as the official sponsor, while 57% incorrectly chose Wendy's. More recently, Nike was the official sponsor of the 2016 Rio Olympics, in which Under Armour succeeded in associating itself with the Team USA women's gymnastics. In the past, several studies have investigated the economic impact of the Olympic Games by using the event study methodology, in which the market value of the Olympics is measured in stock price responses to announcements of Olympic sponsorship agreements. For example, Farrell and Frame in 1997 investigated stock price reaction to the announcements of 26 sponsorship agreements for the 1996 Atlanta Olympic Games. Running the market model over the 241-day estimation window, they report significant negative returns in the 3-day window, suggesting the Olympic sponsorships may not be value enhancing. Next, Miyazaki and Morgan in 2001 also examined market reaction to the news of the sponsorship acquisition of 27 sponsor companies of the 1996 Atlanta Olympics. Unlike Farrell and Frame, The event studies over the 120-day and 100-day estimation period detect no significant negative events, but find significant positive events in 4-day and 5-day windows. So more recently, Dietz et al. In 2013 re-examined these two studies by eliminating the effects arising from confounding events. And their event study over the 120-day estimation window used by Miyazaki and Morgan generated significantly negative returns in the 3-day event window. And similarly, the event study over the 241-day window used by Farrell and Frame produces significant negative returns in the 3-day window. To identify the event that attract most investors to Olympic Games, in this paper, we use Google Trends, which provides search intensity data regarding how much a keyword is searched on Google. Google Search Volume Index, or GSVI, is a relative value, with 100 being the most searched during a specified period. This figure illustrates the Google search volume index for the combination of keywords Olympics and cancellation, and Olympics and postponement for the period from January 1st to March 31st last year. There are two notable peaks for the keywords Olympics and cancellation on January 30 and February 26. And then on March 24th, the data, this is the day when the postponement was confirmed. Olympics and postponement was the most searched keywords during the period. So we chose 3 events for the event study. The first event occurred on January 30 when the WHO declared a state of emergency. At that time, rumors about the cancellation of the Olympics began to spread on the internet. The second event occurred on February 26 when the Prime Minister Abe held the 14th Coronavirus Infectious Disease Control Headquarters press conference and expressed his intention to refrain from holding domestic sports and cultural events for 2 weeks. And then so the event occurred on March 24th when the IOC and Prime Minister Abe agreed to postpone the event until 2021. Next, we develop hypotheses. Previous studies on the 1996 Atlanta Olympics suggested that official sponsorships of the Olympics are negatively evaluated by the stock markets. Assuming that the situation surrounding Olympic sponsorships has not changed, the cancellation of the Olympics may not always be bad for official sponsors. However, in the case of the Tokyo Olympics, COVID-19 was discovered only a year and a half before the scheduled games. The timing of a cancellation may have made it difficult for sponsors to recover their investment. So we set the hypothesis 1, stating stock prices of official Olympic sponsors react negatively to news of the games being cancelled. Second, the postponement of Olympics could have given sponsors a chance to recover their investment. So we set the hypothesis 2, stating stock prices of official Olympic sponsors react positively to news about the postponement of the Olympics. These data in 2013 indicate that the stock returns of Olympic sponsors vary across sponsorship ranks, whereby the larger the investment, the larger the market reactions. In our sample, worldwide Olympic and gold partners invested larger amounts of money than official partners and supporters. So we set the hypothesis 3A and 3B. 3A states stock prices of worldwide Olympic and gold partners reacted more negatively than official partners and supporters to the news about the Olympics being cancelled. And 3B states stock prices of worldwide Olympic and gold partners react more positively than official partners and supporters to news about the Olympics being postponed. To test the hypothesis, we performed the event study methodology. To avoid the effect of confounding events, we focus solely on 1 or 2 day event window. We set the 250 days estimation window prior to December 31st, 2019, the period before the outbreak of COVID-19. We then estimate the pharma French's 3 and 5 factor models in the estimation window. And then using the estimated coefficients, we calculate the abnormal returns, cumulative abnormal returns, CAR, and the average CAR or ACAR across companies in a subgroup. To check hypothesis 3, we perform multivariate regression to estimate the CAR by using the following independent variables. The first is a worldwide, gold, and official dummy variables, which take the value of 1, depending on whether the sponsor is classified as a worldwide Olympic partner, gold partner, official partner, respectively. Individual financial foreign as a shareholders ratio of individual investors, financial institutions, and financial foreign investors, respectively. Our sample consists of 47 sponsors who are listed on the first section of the Tokyo Stock Exchange, which is the largest and most liquid stock market in Japan. The sponsors include 4 worldwide Olympic partners, 14 gold partners, 18 official partners, and 11 official supporters. We select matched companies that satisfy the following conditions. First, those classified into the same industry as the official sponsor based on the Nikkei industry classification. Second, those listed on the Japanese market. And third, those with the closest market capitalization to the official sponsors of January 1st, 2020. So this table presents the event study results. FF3 and FF5 mean the estimations conducted by Pharma French's 3 and 5 factor models, respectively. Since the number of each type of Olympic sponsor is small, we divide the sponsors into 2 groups, worldwide Olympic and gold partners, and official partners and official supporters. The ACAR is negative around January 30, but statistically insignificant for all sponsors in both event windows and models. Then the second, following February 26, the ACAR is significantly negative at the 1% level for all sponsors and subgroups in the 2-day window of both models. So these results are consistent with our hypothesis 1. And comparing the ACAR of the worldwide Olympic and gold partner group and the official partners and official supporters group, we find no evidence for to support hypothesis 3A. Then about the third event, this should be March 24th. Actually, so the ACAR is significantly positive at the 1% level for all sponsors and subgroups in the 1-day window of both models, and significantly positive at the 5% level for all and worldwide Olympic and gold partners group in the FF3 model. And these results are consistent with H2, hypothesis 2, and it is also worth noting that ACAR is larger for the worldwide Olympic and gold partners group than for the Olympic partners and the official partners, partner supporters group. So this result is consistent with hypothesis 3B. So the next table compares the ACAR between sponsored and matched companies. The weighted t-test is used to test whether there is a significant difference in the mean of ACAR between sponsors and matched companies. On February 26, the table shows that the ACAR is more negative at the 5% level for the worldwide Olympic and gold partners group than matched company in a 2-day window of the FF3 model. So yeah, so this result is consistent with hypothesis 1. And in contrast, around March 24th, sorry for the error, but the ACAR is more positive for all sponsors and the worldwide Olympic and gold partners group in a 2-day window and FF3 model. So these results are consistent with H2. Then to check hypothesis 3b, this table presents a multivariate regression results. Models 1 and 2 estimate the CAR using Farmer-French's 3-factor model, and models 3 and 4 employ 5-factor models. We carry out a white test that do not reject the null hypothesis of no heteroscedasticity. And we also confirm that variance differential factors are less than 5 for all models. For all models, the coefficients of gold and official are not statistically significant, while the coefficients on worldwide is significant put at the 10% level for model 4. Yeah, this is the concept with hypothesis 3b. And we also find the individual has significantly positive coefficients of 5% level for all models, while foreign has significantly positive coefficient at the 1% level in models and 1 and 3. So both individual foreign investors tend to be regarded as outsiders in Japanese corporate governance, so that's may change investment decisions more based on their economic rationality than other investors. So although this is a very short paper, but here is a summary of our results. So in this paper, we investigate how stock markets react to the postponement of the Tokyo Olympics Games, which was scheduled to be held last year. And using the event study methodology based on the Farmer-French's factor models, we find sponsor stock prices react negatively to news of the canceling Olympic Games, but they react positively to news of postponement. And our results seem to be reasonable given the Olympic sponsors requires a large amount of money, which cannot be recovered if the games are cancelled. And the cross-sectional regression also shows that the positive market responses to the news on postponement are intensified for worldwide Olympic partners and sponsors with a high ratio of individual investors. So thank you for listening. I welcome any comments and suggestions.
Yeah, so thank you for the presentation, Fumiko. So these are my comments. So first of all, the paper provides a valuable contribution to the financial markets by emphasizing the consequences of the postponement of an event, especially such a massive one, for the first time in the history of the Olympics of Japan. Otherwise, it's a clear and straightforward analysis of the event using the Farmer and French, the 3-factor model and 5-factor model. So I would come with I have 3 suggestions. So the first one would be in terms of formatting. I would like to suggest that whenever you see, like, because I've seen inside the body of your text, like table 1, and I wanted to click on table 1, and it should have directed me to the end of the paper, but I couldn't do that. I couldn't do that, so I needed to scroll down to the end of the paper. So this is my first suggestion, just a small one in terms of formatting. My second question is, this is not a suggestion, it's a question. Why do you think that individual and foreign investors react differently regarding business strategies than the Japanese companies? Let me repeat it. So why do you think that individual and foreign investors react differently regarding the business strategies than the Japanese companies?
Actually, yeah. So I have a lot of research on Japanese corporate governance in the past, and in Japanese corporate governance, usually the system is classified as a stakeholder governance system, not a shareholder governance system. And in the stakeholder governance system, and many, in the past, many shareholders of Japanese companies are actually affiliated companies, and and financial institutions and related group companies hold the shares of their affiliates. So they tend to be a long-term friendly shareholders. So this is a typical Japanese affiliated investor, but the individual investors and foreign investors are very different. And after the latter half of the 1990s, these individual foreign shareholders has been increasing their presence in the Japanese corporate governance system. So actually their behavior and outcome of their increased presence have been examined in many literature, and actually they behave very differently from traditional or affiliated investors.
Oh, I understand. Thank you for the answer. And my last question would be like a suggestions together with a question. So it's like, I would like actually to insert in the body of your text, in the body of your paper, sorry, and not only appear in the findings at the end in the appendix, some notable numbers. For example, I have an example. I would have liked to see the results explained in detail in the body of the text, as other researchers like David Blitz and Van Villette find that FAMA and French 5 factors model controversial or difficult to insert. No, let me repeat it. So, for example, I would like I would have liked to see the result explained more in detail, as other researchers, David Blitz and Van Villette, find that FAMA and French 5 factors model controversial or difficult to summarize in the cross-sectional results. Therefore, I would like to see your opinion regarding the use of both FAMA and French, the 3-factor model and the 5-factor model. Did you find anything, for example, useful using the 5 factors model that you didn't find using the 3-factor model?
Actually, in the finance literature, so I think it is very conventional to use FAMA French's factor models, and in the case of Japan, prior studies evaluated the effectiveness of FAMA French 3 factors in the Japanese market. So that's why we tend to use 3-factor models. However, in the Japanese market, 4th factor, momentum factor, is not effective. So this is also reported by prior studies. And concerning 5-factor, so because this is a relatively new one, only a very limited number of researchers have examined the effectiveness of this 5-factor model. But to guarantee robustness and for checking, I used both models in this paper.
Okay, so just to be clear, you wanted to use both models just to analyze in such a way.
Mm-hmm.
Okay. Thank you for your answer. I'm finished.
Thank you.
Okay, do we have, I've got a comment, but do we have any other comments or observations? The FAMA French model has been around for a while, and it was controversial from the very beginning, whether it's 3-factor, 5-factor, or even more factors. Commercial asset pricing models sometimes use as many as 15 factors, so why stop at 5? The problem with the FAMA French model is that it's not an equilibrium model. unlike the original capital asset pricing model, where you start with the assumptions and you can basically come to the conclusions, you can draw security market line, whatever you like, it all falls out very rationally and logically. That's not true with the Fama-French model. Fama-French model is basically, I don't want to use the word ad hoc, but it's a summary of empirical relationships that, you know, it's with varying degrees of empirical support. The problem is that the Fama-French model is the industry standard. Like if the author had just used the 3-factor model, everyone would be saying, well, why did you stop at 3? Why didn't you use the 5-factor model? And when I say industry standard, it's if anyone proposes, for example, an asset pricing or market strategy, the very first question anyone's going to ask is, does this beat a Fama-French model? You know, whether 3-factor or 5-factor. So we're kind of stuck with it for the time being until someone comes up with a better mousetrap.
If I may make 2 remarks. First of all, just in terms of presentation, I think it'd be fair to say that postponement is positive news only after they thought that cancellation was likely. So if I hadn't discussed cancellation, postponement would have been bad news anyway. Right? That's just like the color of the story. And the other thing, a bit more substantially, is your hypothesis H3, A, and B. This would, what I don't quite, my intuition is that the size of the effects should partly depend upon this, how expensive the sponsorship, but also how valuable is the sponsorship relative to the value of the company. So if the company is extremely large, you know, even the cancel the sponsorship is not a big deal. Whereas for a small company, it might be much more important. So it's not just the size of sponsorship, but the size of sponsorship and its possible payoff relative to the company size.
Yes, thank you so much for the suggestion. Actually, we tried to include the size variable in the regression, but it was, yeah, the size variable was not significant in the regression. So that's why we deleted it. So thank you so much for the suggestion.
Okay, any other comments, remarks? Okay, well, thank you, Fumiko. Very interesting, clear paper, and I think it's relevant because something tells me that we haven't seen the last postponement or cancellation of the Olympics. It's probably going to be relevant going forward. Okay, Flavio, you want to present your papers?
Yes, so please be patient because I have two papers. So, right. So I'll share my screen. I will start with the Turkish Lira one, and then so how does the public like it? I mean, should I present both of them and then you ask questions for both of them, or should I present the first one, you ask question, and then I go to the second one?
Yeah, for what it's worth, my vote would be for doing them both at once. In other words, do the first, then the second, then we have comments, because there's sufficient overlap between the two that some comments would pertain to both.
It depends. It depends on how was it analyzed. I mean, for me, it was analyzed in a different way. So I will share my screen with the Turkish Lira first of all. Oh, let me just open it. So I mean, I have different interpretations for the results.
Well, we'd love to hear them. I mean,
yeah.
I'm very interested in why you got those different conclusions. So if we can discuss them jointly, I think that would be the way.
Yeah, I would really like to do that because in Romania it's very hard to find somebody prepared on the GARCH model. Okay, I found it. No. Can you see my desktop?
Yes.
Right, thank you. So give me a second. All right. Right, so I will I will also read a bit, but I will also interject with some of my personal comments. I don't have anything written except of what you see, so everything will come from my mind. So first of all, I'd like to present myself. So my name is Flavius, and I'm a PhD student. And today I will be presenting the paper called Coping with the Exchange Rate Volatility, a GARCH analysis of the Turkish Lira case. Together with my co-author, Professor Ileana Tache, who unfortunately is unable to join at the moment. So the structure of my presentation will be as follows, with introduction and objectives, methodology and data, empirical results and analysis, conclusion and references, right? So I will start with the introduction. So in the introduction part, I mentioned the definition of the volatility and some of the theoretical aspects of the GARCH framework. So volatility is widely recognized as a measure of the dispersion of returns for a share, currency, or a commodity, or so on, or a bond. So the historic volatility is built on the weighted average of squared returns. So under this assumption, the most financial classical theories assume that the volatility does not depend on time. It is a constant volatility. So therefore, where the volatility does not remain constant over a period of time, all the changes attributed to the estimation of volatility are considered as white noise. So more specifically, the traditional models assume that the variance of errors is constant over a period of time. This process is known as homoscedasticity, right? So, however, it's according to Engel, 1982, the variance of errors does not remain constant over a period of time, especially in the financial markets. We will never see that. So this implies that volatility depends on the time period at which it is measured for the majority of financial markets, as I previously mentioned. Most of the financial markets also do not show shapes of identically distributed how's it called? Identically distributed assumption, because using the GARCH model, you kind of assume that the residuals are identically distributed. So to address this issue, Engel developed in 1982 the GARCH model, General Autoregressive Conditional Heteroscedasticity model. And then I combine this theoretical model with the newspaper news. Let's say I am planning to, for example, for Romania, it is a developing country, so not many people know about the GARCH models, and in order to buy a software to do the GARCH models, it's very unlikely because the Romanian people will not pay money for this. So I really tried to do this analysis in order to make the GARCH model very cost effective. I mean, I really didn't want to involve any money in terms of finding the results which I found, which will be seen later. So also, I like to combine the GARCH model with the political news presented in all of the newspapers, which is again cost effective. So in both of the papers, although I used different Garch models, I looked at the financial news in that specific country and combine it with the Garch model, which shows volatility in different time periods. So in this case, it is Turkey. So the Turkish lira has dramatically dropped against the US dollar. Sorry, can I minimize a bit? Or no, or like, no. Give me a second. Yes, exactly. Sorry about that. Right. So the Turkish lira has dramatically dropped against the US dollar to a record all-time low in August 2018. The Turkish president lashed out at the president of the United States of America, accusing him of economic war. Furthermore, the president of Turkey insisted that his country would endure and survive the economic assault, but neglected to comfort the financial markets, worried about the breakdown of the national currency of strategically crucial emerging market country. So the Turkish president's words failed to calm down the investors' fears that a financial crisis would not spread throughout Europe as well. So in other words, fears of contagions to the European banking remained induced to investors, although the Turkish central bank pledged to provide liquidity to the Turkish banks and to cut foreign currency reserve requirements in order to ease up the Turkish financial sector. So companies that had borrowed heavily in foreign currency became concerned that 45% decrease in the value of the Turkish lira prompted the sell-off of the currency and increased the cost of aiding Turkey's budget deficit. So the Turkish president reaffirmed that the country's economic war was that the country's economy was stable, and criticized the US president again for imposing a sanction over the purchase of Russian S-400 missile systems and doubling tariffs, Turkish tariffs on aluminium and steel imports, due to the fact that an American pastor was being under house arrest for over terrorism charges. So the political tensions between the US and Turkey had started 3 years ago in 2014, when the Turkish police raided the Gülen's medias to detain over 30 people and to draw national and international condemnation. Furthermore, the Turkish court issued an arrest warrant to Gülen, a Turkish Islamic scholar based in the US, that marked milestones in the government's war against its ally-turned rival after the massive corruption investigations. So the conflict between the Turkish president and the Turkish Islamic scholar Gülen persisted throughout the following years and climaxed in July 2016, when the authorities detained thousands of judges and soldiers on the suspicions of involvement in a coup attack. So in simple terms, Gülen was considered by the Turkish president an enemy of the Turkish system. In terms of economy, in terms of the Turkish economy, actually, inflation decreased from approximately 25% in September 2018, approximately to 9.26 in September 2019, due to the 3 quantitative easing moves throughout the period. Furthermore, due to the cancellation of the US sanctions over the Turkish military intervention in Syria, Turkish currency has stabilized. So this paper analyzes the fluctuations of the Turkish lira against the US dollar from January 2014 to October 2019 in order to model and forecast the volatility of the Turkish lira during a major political crisis between the US and Turkey. This study only forecasts uses only forecasts from a symmetric Garch model, namely the Garch 1-1 for this exchange pair. So we are now going to the next part of the presentation, which is the methodology and data. So this chapter aims to present the nature of the Garch models from both statistical and financial perspective. Volatility clustering is part of the Garch framework by basically extending the linear regression model from with another equation known as conditional heteroskedasticity. So it's like from homoskedasticity in the modern times, we go to heteroskedasticity because most of the financial markets, if not all of them, are not let's say they don't have a constant they have, like, let's say, a variable volatility. So right, so a symmetric Garch model means that a symmetric response of volatility to both financial to both negative and positive shocks will be illustrated when a shock occurs. So mainly, even if you have like bad news or good news, you will have it will have kind of the same impact on the chart or on the graph. So the estimation using the maximum likelihood approach highlights the stability of the Garch 1 model, the choice of data period, and the way it affects long-term volatility. So according to Alexander 2001, the Garch models are, like both of them, are frequently estimated on intraday and daily data in order to capture the volatility clustering in returns of the financial assets as it disappears when the returns are observed over a long time period. The estimation of the Garch parameter is done by maximizing the value of the log likelihood function using the time varying mean and variance. For the log likelihood function to be well defined, a certain minimum amount of data is necessary. Frequently, numbers of years of daily data are needed to ensure proper convergence of the model. Thus, the data within the study covers the period from January 2014 to October 2019, resulting in a total of 1,482 daily observations. Again, like according to Alexander 2001, in any Garch model, the estimate of the Garch volatility at the end of the sample period is 1 day ahead volatility forecast on that day. So, however, the Garch long-term volatility can be very different from the 1 day ahead. More explicitly, the Garch parameter estimates can be used to generate the term structure volatility forecasted and forecasts and forward daily volatility forecasts. This is like, I think I kind of misspelled this a bit. The question doesn't really make sense as I wanted. So just ignore it a bit. So I will go to the next slide, which we go to the empirical results and analysis. So I tried to do a combination using the autocorrelation with the Garch model, because I do believe that the autocorrelation, either if it's found it exists or not, they influence in a way the Garch, like they influence in a way the explanations, let's say like that. So initially I started with the definitions, so that will be presented in this paper and with actually the tests that will be done. So the autocorrelation is the early evidence to support the use of the Garch models. Therefore, the box-pierced or the Q-test was used to identify whether autocorrelation within the data exists or not. So the thing is, autocorrelation in general, it should be between -1 and 1. So it's like a perfect negative autocorrelation, or perfect positive autocorrelation, or no autocorrelation. But in my case, I used like the autocorrelation with I just use it to see if it exists in terms of interpreting it in my own way. So autocorrelation, or better said, serial correlation in returns does exist for the Turkish lira against the US dollar for the period mentioned. So serial correlation can be referred to as lagged correlation, as it measures the relationship between the current value of the Turkish lira against the US dollar and its past value. I mean, both, like the pair of current value against the US dollar and the past value of the Turkish lira against the US dollar are measured in this autocorrelation. Since the Turkish lira against the US dollar exchange rate exhibits serial autocorrelation of the residuals, an investor could believe that the trend seen in the serial correlation of the residuals might also be the trend of the Turkish lira against the US dollar. Here I mean about the prices. I mean, you calculate the autocorrelation, but an investor, if he sees only the autocorrelation, they will think that most probably I was talking about the prices. So the autocorrelation can also be presented as either a momentum appreciation of a certain stock, commodity, currency, doesn't really matter, or depreciation, depends. So for example, if you monitor let's say a currency for 2 days and you see that it is rising for the 2 days, most probably in the next 2 days it will rise as well. So yes, right. So this is what I wanted to say about the autocorrelation. For me, I analyze it from a different point of view, not because I'm using a different method of calculating the Garch model, and you'll see further on. So in other words, since the correlation is present, an investors could characterize it, as I said, could characterize it as a momentum appreciation or depreciation in the value of the Turkish lira against the US dollar, since its past value seems to influence the future value. Here we have a chart. So everything is done in Excel, because as I said, I wanted to be really cost effective, and I didn't want to use any sophisticated software, because I wanted my analysis to be available to everybody, and also to be able to do my analysis for any other aspects. So for example, if you want to do it in agriculture, and you look on the stock market on the price of wheat or things like that, you can do it using the Garch model. I really wanted to make this affordable to all the citizens. So everybody who has Excel, which most of the computers do, they can do this by themselves. So here in this chart, we are presented with the unconditional volatility. As I said, is measured by squared how is it called, lagged residuals. But we can see, I mean, we can see both of there are two types of volatility. So first of all, the first line, the red line, is the unconditional volatility, which is constant at all times. So this is homoscedasticity, and I really wanted to emphasize that the Garch estimation volatility is not the same. I mean, it's, even if it might in the end be the same, like the same percentage or something, the trajectory, or actually the road that it goes to the end, it goes up and down, and it's not a straight line. So here, the estimated unconditional volatility using the equally weighted average of all the squared returns mean deviations differs markedly from the long-term volatility estimated by the Garch-1 model. This is not surprising. I mean, it was really expected. So the parameters within the Garch model are optimally estimated using the maximum likelihood, more specifically using Excel solver. So everybody has access to this. So that's what I wanted to do, because most, I mean, the prices, you can find it, you can find the prices online. You can simply let's say use the my analysis, and also create a chart in order to see the trend to where the volatility is going. Is it going up? Is it going down? You should go purchase it now, or just wait because volatility is too high. So we will see a bit later. So it was identified that there is a high persistence in volatility and low reaction again in volatility fluctuations since the tensions between the US and Turkey began in 2014. The lack of reaction to such fluctuations might be that investors got used to the swings in the value of the Turkish lira, since the currency is the most is one of the most of the world's most volatile currencies. Furthermore, the persistent coefficient beta shows a value that illustrates high persistence in volatility, since the Turkey is very close to Syria, Iraq, and Iran, countries where political instability and wars persist. Surprisingly, alpha, which is the constant, seems to illustrate a relatively stable market. The fluctuation of the Turkish lira against the US dollar exchange rate volatility was not very unusual, except, so the fluctuations between these two currencies were not usual. except the two major spikes in the volatility of the Turkish lira against the US dollar that occurred during and after the failed coup attempt against the Turkish president, and also the Istanbul's mayoral election in which he participated as well. So, here we have a forecast. So let me present the way I did it. So I simply collected the prices of the Turkish lira and also the against the US dollar. So this pair, and with this I used only mathematical interpretation. So I didn't use any regression. I didn't use, although you can use regression for the Garch models, and it's very easy. I didn't want to do that because for me and for my country, we are very used to mathematics, and it doesn't matter if you're good or if you're bad at mathematics. Compared to the Western countries, even if you don't know mathematics, you'll still do it. You'll still. It doesn't matter if you're good or not. You'll still do it because you will have some concepts of the mathematics. So it doesn't matter if you're good, bad. You'll still know mathematics. So it's a very big focus in my country. So if you present something to people, they will ask you, where is the formula? Where is the formula that was used to calculate this? And I wouldn't have been possible to tell them just the formula without me practicing it and offering an example. So after I gathered the data of the prices of the Turkish lira, I did very complicated calculation, like classically, like simply following the formula, but using Excel as my help. And then to calculate the Garch volatility, I inserted few assumptions in the Excel solver tab for the Garch 1, because in order to make it Garch 1, I needed to put 4, as far as I remember, constraints to the model. And here it is a forecasting of the volatility. So it's like here, if going back, here is the data, like from, as I said, 2014 to 2019, and these are the whole data. So like no data was existent back then. I mean, in 2019, it was the day when I started this analysis. Here, I project the future volatility of the currency. So as we can see, the volatility of the Turkish lira against the US dollar will increase. I did it for, as we can see, 3,065 days, which is not say correct. It usually is done for a short period of time. It's like weeks, 1 week, 1 day, 2 weeks, but not more than that. But I just wanted to actually show that the model can do that, and you can do that. I mean, if you take my template, for example, and you just switch the prices from whatever you want, everything will be calculated according to the formulas which I put in, and also the graph will be done according to what you put in. So as I mentioned, realistic forecasts should only be done for the short period of time, such as days or few weeks, in order to capture the estimated value as closely as possible to the real value. However, the purpose of this paper is to capture the trend. I'm not interested in the efficiency of getting volatility at, I don't know, 0.001 point. I'm interested to see the trend, to the trend of volatility, to see what you expect in the future. So it has been identified that volatility, as I mentioned, exchange rate will increase in 2020. Therefore, investors, this is a recommendation. Therefore, investors should be very cautious when speculating the trend of the future value of the currency. So the thing is, I kind of tested. So this was done in 2020, this study. And I actually looked on the Turkish price, as like the volatility of the Turkish Lira, if it was or not volatile. And it kind of was for the whole year. So regardless if it's kind of real to use the whole year to forecast, still I consider myself, I did a good job. It doesn't really matter if it's impractical. But that's why I suggest only for people who want to follow this study to only use statistic forecast, like realistic forecast, like days and weeks, not as I did for 1 year, because most probably you won't get the same result as I did. Maybe I was lucky. And now we go to the conclusion. So the Turkish economic war between the U.S. and Turkey seemed to have to be over, as the president of the United States of America lifted the sanctions of for Turkey. The reason behind this decision was Turkey's promise to make a ceasefire permanently in northern Syria, as Turkey began combat offensive just after the U.S. troops had been withdrawn. So it's like Turkey realized or done kind of a deal or something like that with the U.S. president, promising that they will call the Turkish troops back to Turkey without any war. But as soon as the American army left, Turkey invaded the northern Syria. So our investigation arrives at the conclusion that the Garchon 1 model could be successfully used to predict and forecast the volatility of the currencies, especially during the political crisis, than simply using unconditional volatility. Thank you for listening. I will also show you my Excel spreadsheet in which I've done these tests.
Yeah, Flavius, I think it's time to move on to the next paper. We've kind of gone over quite a bit.
Oh, sorry.
I think in the interest of time, it might be useful to everyone if you would focus on the differences between these two papers rather than.
Okay. So I'm done with this one. It will be shorter. It will be shorter. So this one, right? So in this paper, what is it called? Here. Right. In this paper, we focus on the pound sterling exchange rate volatility in the Brexit context using the e-Garch model. Is different from the Garchon 1. A comparison between the effective pound sterling volatility and the e-Garch estimation for the period 2016 and 2019 was also made. So the same structure of the paper, but it's different in some aspects. In terms of Garch framework, they are kind of the same definitions with different words. Here as well. I'll show you just what is different. So what is different is the fact that compared to the Garchon 1 model, we have a new variable that measures, in this case is the leverage effect. Yeah, so the leverage effect measures differently, because it's like the negative news have a much more impact on the market than the positive news. So this is the difference between the Garch 1.1 model and the eGarch model. So I just gave the definition. Then I started to see the political context of this country. So it was very, for me, interesting at that time, because the pound sterling has dramatically dropped to a record low since the UK voted to leave the European Union in June 2016 referendum. The result of the referendum severely impacted the global markets worldwide, and the major currencies such as the US dollar, British pound, Japanese yen, and euro. However, since June 2016, the greatest emphasis is put on the pound sterling movement against the US dollar due to the post-Brexit uncertainty. Furthermore, the speculation about the hard Brexit has also caused disruption in the correlation between the US asset prices and the UK, the pound. So until October 2016, the gilt yields and the pounds moved in tandem, which is very much in line with what had been previously seen historically for the market. But since the flash crash, the days leading to the flash crash, the correlation between these two markets, 2-year the yields and the pound against the dollar, have dropped. So it's yeah. Moreover, amid growing fears that the UK will take a major economic hit, that the correlation between the sterling and the emerging market currencies index has significantly increased, according to Bloomberg 2006. So these are like more economic news regarding the fall of the sterling pound. So also like a motive, let's say, regarding the flash crash was the thought that, was thought to be triggered by the trading algorithm, which caused the sharp movement in the value of the pound, and the speech held by the French President François Hollande, in which he stated that UK could not have access to the EU's single market unless it accepted the free movement and labor market. So this paper analyzes again the fluctuations during from the period from June 2016 since the UK voted to leave the European Union to September 2019. This study uses only the eGarch model, right? So in other words, yeah, let me just rephrase this. So this study uses the exponential Garch, the eGarch model, introduced by NASA for the GBP against the US dollar exchange rate pair, and compared the same Garch model, was compared, the same eGarch estimated model was compared with the actual realized volatility taken from investing during that period. So we'll see if the model, I mean, the trend of the EGARCH model was close to the trend of the realized volatility that is provided on the websites. In this case, is in the investing website. But it doesn't matter which database you use, because the results won't be that far off. Okay, so as I mentioned regarding the leverage effect, so an asymmetric GARCH model means that an asymmetric response of volatility will occur. More specifically, negative shocks will lead to a higher volatility than positive shocks, as I mentioned before. So we use again the likelihood approach. Nothing important. So in this case, the data within the study covers the period from June 2016 to September 2018, resulting in a total of 868 daily observations. Here again, now we see the difference. We see a bit of the difference. So in terms of the previous article, the autocorrelation was how is it called? Existed. The autocorrelation existed. In this case, the autocorrelation using the same test doesn't exist anymore. And here comes the interesting part, because both of the results, even if the autocorrelation exists or not, have an impact, or have an impact on the market. So the serial autocorrelation, as I said, it doesn't exist. So we accept the H0 hypothesis that autocorrelation doesn't exist, and we'll see why it doesn't exist in the study further on. Here we compared, as in the last study, the unconditional volatility with the conditional volatility provided by the EGARCH estimations. So we can see that the unconditional volatility records, let's say, 10% and does not differ significantly from the EGARCH estimation, which is 10.02 compared to 10.04. So it's like the straight line, the unconditional volatility, does not depend, returns kind of the same result as the GARCH, the EGARCH model, because although the EGARCH model goes up and down, the result is kind of the same in the end. It doesn't always happen, but it happens quite a lot. So furthermore, I'm just explaining what I found within the study. So the persistent coefficient beta shows that a value that illustrates, okay. Okay, so the coefficient beta shows high persistent in volatility since the Brexit voted in June to leave the European Union. The sample covers approximately 2 years during which some extreme market movements happened or were recorded. The estimate of the EGARCH constant, I think is gamma, no, or omega, and the long-term volatility. So it's like it was recorded the estimation of the EGARCH constant omega and the long-term volatility are not extremely high, but large enough to emphasize the Brexit shock. And I think it is important because in general we don't pay enough attention to the constants, regardless the models, especially in the EGARCH in the GARCH framework models. So this can occur, like this event can occur even in the markets being stable for some time. However, with the leverage variable, in this case it's gamma, I think so, which measures the asymmetry of the leverage effect. So since gamma shows a value greater than 0, more specifically 0.24, let's say, then we can draw the conclusion that positive shocks, in this case good news, generate much more volatility than negative news. In general, negative news indeed generate much more volatility, but because the UK since 2016 to 2019 were like only destabilization, and the currency dropped, and everything is kind of the market got used to the pound being low. So this was kind of a surprise for them to get a positive news. That's why the gamma gamma variable shows that the good news was really expected by the population. They were kind of sick of only bad news and negative news. So figure 2 presents the identically distributed unconditional volatility estimates of 10.14% is approximately the same as the unconditional volatility, as I mentioned, and we'll show this in a chart. So as you can see, the EGARCH model shows like up and down, goes up and down, where the unconditional volatility is only a straight line, but still they result in the same, almost the same, approximately the same answer. So, right, so what is important? So yeah, figure 2 also illustrates that between this time period, a massive spike in volatility occurred after the result of the Brexit vote announcement, and as the vote of the UK's withdrawal deal from the European Union looms, volatility is expected. So everything, I mean, I do believe that this model, so please contradict me if I'm wrong at the end. I do believe that this model can show exactly what was happening at that time. Here we have a different chart. So everything, all these charts are done in Excel by me. Nothing is copied, nothing. So everything, I only took the prices from a database and I simply used formulas, and I did everything by myself. So here we can see the EGARCH estimation volatility, the chart, like the line. The blue line is the EGARCH estimated volatility, and the green line is the realized volatility, so which actually was reported that it happened. That was the real volatility at that time. So we can see that they are kind of close. I mean, they are very well monitored, but we can also see that there is a discrepancy, and we will see why straight after that. So figure 2, as I said, compares the two lines. So it must be mentioned that even though the 30 observations from the data of the realized volatility are missing due to the lack of efficient data, the EGARCH estimates seem to closely mimic the behavior of the realized volatility. So that's why we had that discrepancy, because we were missing 30 observations, and we don't know on which part. I mean, the time period is like for 3 years, and we don't know. I mean, we exactly, maybe an observation was missing in 2016, an observation was missing in 2017, and 28 observations were missing in 2019. We don't know. So that's why we encounter with this discrepancy. So in other words, as I mentioned, due to the missing data, the realized volatility trend is a bit delayed compared to the trend provided by the eGarch model. So it must be mentioned that the eGarch model has larger reactions to the negative news compared to the realized volatility. Therefore, each spike in volatility recorded since June 2016 concerns major political events or decisions within the UK government, such as the invocation of the Article of the Treaty on the European Union, the release of Brexit transition plans, and the EU deal approved by the cabinet. I'm almost done. So we have a short conclusion. So after the Brexit shock in June, the volatility of the pound sterling increased massively, only to stabilize in November 2016 with a normal fluctuation similar to the period before the Brexit vote. Since then, most of the major political events or decisions have caused a dramatic rise in the volatility of the GBP. Therefore, it must be mentioned that the eGarch model is very close to mimic the volatility trend compared to the realized volatility, and it could be used to predict volatility in the currency in the future. So this is the end of my presentation. Thank you for listening. So I'm really ready to hearing your suggestions, and yes, that's it. Thank you for listening.
Okay. Fumiko, do you want to go first with your discussion comments? I think you're muted, Fumiko. Oh, thank you.
Okay. Can I share my slides?
No, just give me a second, because I kind of minimized something.
Because you share your slides, so I can't do that. So please.
Yeah, I'm trying to remove it. I'm trying to remove it. How can I stop it? Oh, stop sharing. Okay, here. Yes. I think it's. But yes, I'm ready. I'm ready for the questions.
Okay. Thank you for the presentation. I really enjoyed reading this paper.
Thank you. I appreciate that.
Okay. This paper uses a forecast from the eGarch model from the GBP USD exchange rate and compare the estimates with the realized volatility for 2016 to 2019. And yeah, I think, yeah, this paper is very interesting, but may need additional analysis, I think. And so as you, yeah, the authors show this graph before, but so this compares the volatility. Yeah, the first one is based on IID, unconditional volatility estimate, and the second one is unconditional eGarch volatility. And also, yeah, this chart, yeah, based on this chart, yeah, so you said the eGarch model is close to mimic the volatility trend compared to the realized volatility. So I have two suggestions to this paper, actually. So I think so the first suggestion is that maybe, yeah, so I understand that the eGarch is, yeah, useful, but maybe, yeah, there are several variety of Garch model aside from eGarch. So maybe comparing with the different models will enhance the value of your paper, I think. And also concerning the evaluation, so you just drew graphs and set the EGACH. EGACH results is very similar to the realized volatility, but to compare the different, so the results based on the different models, there are some kinds of statistical tests for comparison. So maybe using showing your result using the quantitative evaluation may be better, I think. So that's all. Thank you.
Thank you for the suggestion. Thank you very much. So the thing is, it's kind of a problem. I do agree with all your suggestions. I could have used many other GARCH models, like different modules that may be more specific or more accurate, let's say. But the problem is I'm doing this manually, let's say. So the thing is, I need to revise all the mathematical formulas, and I need to know exactly what they are saying, what I should, how should I analyze these variables. And at this point in time, I only done the GARCH one, the eGARCH, and it will come the GJR GARCH, which is the Gloston, Yaganathan, and Runkel, as far as I remember. And I will compare. This will be for my thesis, actually. My final thesis is like doing the eGARCH, the GARCH 1.1 eGARCH, and the GJR GARCH, and compare them all these models, and to see which one provides the best fit for the pound sterling, because I'll do like pound sterling in a much more evolved way for my final thesis. This is only an article, but thank you for these suggestions.
Okay, thank you. I've got a couple comments. I think both papers are fairly straightforward applications of GARCH and eGARCH. It's nice to see that done. And I think you've made a pretty good case for using these kinds of forecasts to try and get a handle on what future volatility might be, rather than just using the unconditional standard deviation or unconditional volatility. You put a lot of emphasis in both papers on political events, on Turkey's deteriorating relationship with the US in the first one, and then Brexit in the second. I understand why you did that. If you look at contemporary news sources, you can see that that was dominating the news, and it's associated with big spikes. So my point here, though, is that attributing price changes to events is actually pretty difficult and sometimes very arbitrary. And the two cases that you pointed out, I think is pretty clear, but it isn't always clear. And it's a problem, like with my paper as well yesterday. Okay, it's a structural break in the series, and then you start looking around, and it's always possible to find some event that you might think is driving the markets, but you never really know. And it's a methodological problem. Maybe it's a philosophical problem generally. Second is I had a lot of the same comments that Fumiko had. I personally think that it's easy to estimate the value added by GARCH models, mainly because at the end of the day, they're nothing but a function of the past error term and the past volatility, both of which are already known by the markets. And in particular, one problem with the standard deviation is that it's symmetric. It treats losses and gains symmetrically. Well, why should investors care about gains? They probably care more about losses and avoiding losses than they care. They're much more. My assumption is they're much more concerned about meltdowns than they are melt-ups. Okay, and there are measures that take this into consideration. Harry Markowitz, right after he wrote a seminal paper on mean variance, wrote another one advocating the use of the semi-standard deviation, which basically focuses on losses rather than gains. And I never had much of a go with it. It crops up every now and then in the literature, but it looked to me like a perfectly sensible approach. And there are other approaches too to handling the asymmetry. For example, in the option pricing literature.
Yeah.
You know,
Black and Scholes.
Well, it's not just Black and Scholes. It's the question is, what do you do when the prices drop, when the asset prices are being driven, not by a continuous process, but by a mixed diffusion and jump process? How do you take those jumps into account? In option pricing, it can be a pretty serious issue because using historical data, you know, you get any result you wanted after the 1987 crash or after the flash crash, depending on whether you included that one observation or not. You came to dramatically different results on the option pricing doing that. You did focus a lot in the first paper on the Turkish Lira US dollar exchange rate and attributing a lot of it to the worsening relations between Turkey and the United States. And I think you're on fair ground there, solid ground. But just as a check, it might take a look.
I didn't get that. Can you please repeat?
No, I think you focused on the Turkish Lira US dollar exchange rate.
Yes.
And you discussed quite a bit about how the worsening in US relations led to spikes in that exchange rate. And I think you're on solid ground there.
Yeah.
But just as a check, you know, Turkey's a very volatile economy, very volatile market. It has been for decades. There's a lot going on in Turkey and with the market that probably can't be explained necessarily or attributed to diplomatic relations getting worse with the United States. I would just suggest take a look at some other exchange rate, maybe Turkish lira against the Swiss franc, for example. Now that may still be affected by deterioration in U.S. relations, but it'd be a nice check to see if you at least get different results. And then finally, one question I had was, how would one use this? I mean, to whom would the Garch estimates? Why do we care about estimates of future volatility? And I think the answer is that risk managers care a lot. You know, if they see a big increase in volatility, if they see an increase in forecasted volatility, they might want to have traders cut back on their exposures, things like that.
Exactly.
The other obvious application is in option pricing. You know, the one unknown parameter in using Black-Scholes or pricing options is the volatility. You want to know, you try to get an estimate of future volatility. So maybe it's useful there, but in that context, is it really more useful than just taking, say, a simple 7-day moving average of the volatility? You know, I don't know, and that's what some of the diagnostic statistics that forecast accuracy statistics that Fumiko was suggesting might be useful. Finally, you know, it's possible to reverse if you have a foreign currency option. And I think I know we do for the British pound against the dollar. For the Turkish lira against the dollar, I don't know of any options that are market traded on that. You probably get a bank to write you a contract. But interesting to me is you know, implicit in option prices is a forecast of future volatility. Like for the whole U.S. market, we have the VIX, and it'd be very interesting to me to see how these Arch and Garch forecasts, how well they forecast volatility relative to what the market's forecasting implicit in the option prices.
Yeah, I completely agree, and also I would like to address your first comment. Yes, I mean, I didn't talk about the disadvantages of the models, but they are there. There are plenty of disadvantages, especially for Garch 1.1. The eGarch, it's let's say balanced. I mean, it doesn't really the pros are like better than the cons, let's say. So indeed, overestimating, for example, sometimes for the Garch models, both of them, like Garch 1.1 or eGarch, there are problem of overestimation or overfitting or oversizing. I can't. There is an English word which doesn't really come to my mind, but it was something with overestimating, and also if it comes, I'll come back. I'll come back to you.
Okay.
Thank you. I appreciate your comments.
Okay.
May I?
Comments, observation? Oh, sorry, Daniel.
I may have a few things. One is that it'd be quite straightforward to look into the stability of the Garch or E-Garch relationship by splitting the samples. I'm just eyeballing, for example, the Turkish chart. It looks like the volatility is going up and down a little bit for a long time, and the last bit, it starts going up and down by large amounts. So maybe there's even a structural break in the Garch relationship. In both of those cases, also in the case of the UK, also talk about it rather in these terms. So it could be that even there's a period of more or less, fairly, nothing much going, rather uninteresting bit of heteroscedasticity for Turkey, and then a big wave arch steps in. So I think that'd be easy to do, make it more interesting, more, I think that's relevant also for market participants. For both cases, I think that Brian makes a good point that an easy thing to compare with is a short period estimation of just of variance. After we know from theories of time aggregation that variance is one of the things you can estimate better and better with shorter and shorter, more and more frequent observations of a short period. Trends you need a long time for, but variance you can estimate if you have sufficiently dense data of exchange rates. You can get hourly data if you want, and then that's an alternative. Also in this connection, a couple of minor things. I echo the point you somewhat overemphasize the US politics angle for Turkey. I mean, there was this coup attempt in Turkey, and things like that, so it was pretty serious without the US involvement. Even the paper, for example, at the end, you mentioned policy towards the Kurds and so on. Just in terms of selling the product, it's a bit of a distraction. Selling the product is important in academia. So it was like, why is this guy talking about the Kurds now at the end of the paper? So, and also in the paper on the sterling, you mentioned this flash crash, which was October 7, I think.
Yes.
But then it doesn't appear in the data. And I think it is because you use like end of period data. So if you mention something, give it some prominence, things like that appear. And maybe you had like, and by the way, the variance differs in time of day. I think that it's like US mornings is more volatile than US nighttime.
Yes.
So it'd be nice to include that flash crash.
Yes, I agree. Actually, the flash crash was, it was, how's it called? It came, let's say, because during the Asian trading hours, the sophisticated system starts selling the pounds. So the thing is, it is a problem regarding the time zone. So it's like the UK people most probably woke up and they saw the flash crash. They were like panicked and they start selling as well. So I think I really think that this is like the trading algorithm as well as like trading in different time zones is it's tricky.
Okay, my personal memory of the flash crash was that the mechanism was that there was a drop in prices, increase in volatility, a lot of leverage, and risk managers started telling people to cut back on their exposures. So they sold, and that increased the volatility even further. It caused risk managers to get even more upset. And that went on until basically a lot of the leverage had been flushed out of the system, out of the financial system. When it became profitable to hold an unleveraged position in a bond, then the whole selling came to an end. But that's just my observations from the period.
No, I mentioned that as well. I completely agree with this point, with the sell-off of the pound.
Okay, do we have any other comments, observations?
Oh, one other thing. You have this asymmetry parameter, 0.247. Does it come with a standard error?
Yes.
I didn't see that in the paper somehow. Maybe I overlooked it somewhere.
I don't include anything regarding the errors, like the errors of the model.
Okay. Well, I think we'll wrap it up there. I want to thank everyone for their participation. We had a very diverse set of papers, a lot of what I thought were pretty interesting comments on the part of the discussants, and a pretty lively discussion. So thank you very much.
Thank you as well.
Thank you, Brian, for your sharing.
Okay.